Hi there, I'm Mark Sebastian. I am the founder of OptionPit.com, and this is learning about the covered call. This is options for money managers, registered investment advisors, and investment professionals. I'd like to remind you that this is for education purposes only. None of this should be considered investment advice. Options have risk, so take that in consideration. For those of you who don't know who I am Mark. I founded OptionPit about 9 years ago. We are an education consulting company. We offer services to individuals, giving them education on how options work, how to make money options, how to trade options. And then for professionals, we do consulting and education as well. We work with hedge fund managers, money managers, registered investment advisors, the whole 9 yards. And we work with them to help them implement and test and develop strategies that they can either run within their fund, run with for themselves, or run as a as some sort of SMA program, things like that. So with that in mind, let's talk about what you're going to learn. So what we're going to cover is how options are an insurance. We're going to cover the basics of a call option, how selling a call can be a form of insurance, characteristics of a covered call, how that quote-unquote doubles the dividend, and what a covered call campaign looks like. I am going to try and keep your time to under half an hour, and I will then take a bunch of time to answer questions from people. So it's everything you could ask for. So insurance. Options is insurance. I know it doesn't seem that way. We used to joke on the floor that this is America. Stocks go up. I don't know if that rings true to anybody, but as a whole, over a long period of time, that's not entirely untrue. Stocks do go up. But intermixed with that stock going upness is a lot of stocks going down. And if I pull up a chart of, let's say, the S&P 500, which I'm going to do right now, you can see there are some pretty significant periods of time where, in fact, stocks do go down. And if I pull up a longer chart, I could show you even more dramatic sell-offs than what we see here. But consider that around this time last year, the S&P had peaked out at around 2920, 2930, and subsequently dropped to 2350. So, a lot of people like to say, look how much we're up on the year. It's a lot. But year over year, today is the 30th, year over year, we're up less than 10%, or about 10%. It's really not that impressive. So that's why I love when you watch financial TV and they talk about, oh, year to date, stocks are up so much. Yeah, but are they really up that much? No, they're not. So how do you protect a portfolio from losing money? And I just gave that for some perspective. It's very easy to forget how ugly things can be. But how do you protect a position from losing money? And, let's kind of briefly talk about that. So this is a stock. This is Coca-Cola. At the time, it was $45.40. It's now up about $8 from there. But I think we all understand the economics of stock prices, right? Stock goes up 1 point and you own 100 shares. How much money do you make? You make $100. Stock goes down, you lose $100. Pretty cut and dry. Not that hard. This is a call option. It was a March 2019 44 call for $1.50. So, how is this call? And this is why people talk about calls being speculative. They're not. They're insurance. So on Coca-Cola, yes, I'm paying $1.48 for this call. Right? We all see this. And what am I getting for that $1.48 cost? Well, if Coca-Cola doesn't go above above $44, the most I can lose is this piece between 0 and negative $148. Everything here. The most I can lose is $148, the cost I paid. All right, so if Coca-Cola goes from 44 to 42, I lose $148. If it's a stock, I lose more. So, in return for this $148, I get that protection, but my cost, my break even isn't till 45, in this case, about $45.48. So I need Coca-Cola to pick up about $1 in order for my call to make me money. It's simple. Buying a call instead of buying a stock creates an insurance pact. Calls are not speculative. They're an insurance pact. So, by buying a call instead of stock, the seller agrees to let me buy the stock for $44 if I pay him $1.48, $148. All right? In return, I pay that insurance cost. So who wins? Who wins in that trade? The answer is, over time, nobody. Over time, nobody really wins on these insurance deals. There's a little bit of what they call volatility risk premium that's priced into options, but it is not the crazy annual return that you may hear a lot. It simply is not. The point is, my friend Russell Rhodes, who works for Tab, did a study on selling straddles and buying straddles in front of earnings. And what's interesting is both the buyers and the sellers lost money. And the difference was the market maker bid-ask spread. So there really is not a lot of money in selling premium or buying premium if you're simply trading the option. However, if I take it a step further, if the seller of the option owns the stock at a lower price and sells a call against it, how does he or she feel when the stock gets called away? How does he or she feel when the stock gets called away? The answer is happy. The answer is happy. So let me you know, which should make some intuitive sense to you people, right? You know, I buy something, you know, we could say Coca-Cola for $42. Now let me go here. So I buy here for 42 bucks. And I sell my call at my 44 call at $1.48. So above right here, I no longer make money, and above here, I lose my stock. All right, well, if I got to buy 100 shares for $42, so I pay $4,200, I'll make that a negative sign. And then when I take it off, I collect $44 from selling the stock, and this $148 from selling the call. Am I happy or sad? Am I happy or sad? I am indeed happy. All right. So what's funny is this is a covered call. Really simple. Basic covered call. All right. If you don't know what a covered call is, a covered call is long the stock and short a call against it. It's not that crazy a trade. So a covered call is a combination of long stock and a short call. The combination creates positions that can produce positive cash flow, increase an investor's margin of error, and help the investor make sell decisions. And this is a key one. This is key, and this is key. And these are all things that you really can't do that easily with what we would call a robo-advisor. So let's talk about making one. So we start with Coca-Cola. And we buy Coca-Cola for $45.40. The next step in my trade is selling a call. In this case, I'm selling an April 46 call at 44 cents. All right, so what I want you to notice about a short call is I collect all this premium above the strike or below the strike price, and I lose money above the strike price. So now let's put these two together. I'm long the stock, and I'm short the call. What do I have? Well, if you look, the stock's trading $45.40. I'm still profitable below my purchase price. That's right here. See this? You know, I've now got some leeway below 45 bucks. Above $5, I make money all the way up to 46, and then at above $46, I am topped out. I'm topped out on the amount of money I can make. It's all here. If we drop below 44, essentially 45 bucks a share, I'm now losing money again. So it's giving me a little bit of a cushion. This is my cushion. So what is our net? We collected premium in the trade, which lowers our cost basis on our stock. We limited our upside because if the stock moves above our call strike price, our stock will be called away. Finally, if we own the stock lower, though, we're happy. You know, I'm always shocked when people are annoyed that their stock got called away. To me, that is a good thing. So now what if? What if the stock does not rally? What if the stock sits there? Do stocks ever sit there? Yes. Well, that's the beauty. I get to keep the dollars. Well, you know, if the stock sits there, I get to keep the dollars. All right. On a stock with a dividend, I make more because I get to collect my dividend. Right? What's the dividend on Coca-Cola is 40 cents a quarter. If I can sell an out-of-the-money covered call at 40 cents once a quarter and collect 40 cents a quarter in dividend, what have I done to my dividend payout structure? I've doubled it. This is where we get our concept of doubling your dividend. In truth, most of the time, what I am doing more than doubles the dividend. Right? I get an opportunity to sell a call maybe every month. That is massively valuable to me. All right? If I do things right, I can double, triple the dividend. That is so valuable to me. All right? So let me kind of walk you through just a really basic covered call setup. And we can use thinkorswim today. I am going to pick a stock that I like a lot. All right, so as you know, we put up a one second. As you know, we put up a weekly letter in our silver membership where we dig into one stock and develop one trade, and they're all stocks that I love and want to own. So in a bit of irony, on the thinkorswim platform, I'm going to look at TD Ameritrade. This is a company that I personally want to own. All right, and I like owning. I'm going to get rid of this. All right, that's gone because I want a clean Ameritrade position. So we're going to put in AMTD. And I'm going to start with the stock. And this is a paper account. This is not real money, folks. I go in, and again, none of this is investment advice. I go in and I buy 100 shares of AMTD, TD Ameritrade. If you're a silver member, you know why I like this stock. So you can see I now own Ameritrade stock. Let me widen this out so you can see what I'm doing. This is actually part of the reason why I love doing this intraday, because I can actually build the trade. Now, TD Ameritrade does have a dividend. It pays a dividend on November 4th, which is about 5 days from now. Pays 31 cents. I am going to go to December, regular December. Stock about 39.32. And I'm going to sell a call. In this case, I'm going to sell the 40s. I'm going to sell it at $1.30. You know, I have some alternates I could look at. One of the nice things about the weeklies, if I really want to just keep it to a month, I could look at the November 29th. And I could do something more nuanced. You know, we have a 31-cent dividend. If I want to double my dividend for the month of November, why don't I sell a 42 call at 30 cents? You know, I'm not going to dig into my rules, but generally speaking, when I sell a covered call, I like my call to be worth at least 1% of the value of the stock. So TD Ameritrade is $39.20. What's 1% of that? 40 cents, give or take. So I'm going to sell a 41.5 call at 40. I have now built my covered call. So if thinkorswim, if TD Ameritrade goes from $39.32 above $41.50, I lose the stock. But in between there, I get to collect the dividend and keep the 40 cents of call premium I sold here. That's the beauty of this trade. Obviously, there's nuances, but that's the beauty of doubling your dividend with covered calls. And in fact, if I'm collecting 40 cents every month on TD Ameritrade, how much yield do I produce over a year? $4.80. If I collect 4 dividends that pay me 30 cents in TD Ameritrade, how much do I collect? $1.20. So, in using options, I'm not just doubling my dividend. What am I doing? Well, I haven't taken arithmetic in a very long time, but my 4th grader is taking it right now. And last time I checked, $4.80 is 4 times the value of $1.20. My math right on that, Alicia?
I will not listen.
Just say yes. The answer is yes. My math is right. I doubled my dividend. So this is a month-by-month walkthrough I did for the first 6 months of 2018 on a stock. Right? And I believe this is also Coca-Cola. Might be Verizon. But I think I left the stock price there, the stock name off on purpose. And what I want you to notice is that at the end of my holding period, January to June, what happens to my stock price? Here's the stock open price, stock close price. What happens to my stock price? It goes down. So the beauty is in using covered calls, here's that covered call sale price. Here's the strike prices that I'm selling. I get to collect $2.75 in premium over this period of time. I didn't even put the dividend in here. At the end of the holding period, when I add my covered call price, I make 82 cents. With just the stock, I lose $1.31. Pretty neat, huh? That's the power of these things. So here's, I want you to just kind of look at these sum totals. You know, the beautiful thing is my net, I collect in this period $1.18 in dividend. I collect $2.75 in call income. Again, more than double my dividend. My stock P&L is a loser, but I still win. And, you know, we talk about, especially for value investors, you know, we look at the S&P and see, oh, it's off to the races. It's 3,000 million, whatever. But in truth, the names that pay big dividends are not the names that are off to the races. All right. So that is why covered call programs where you double your dividend can really provide so much yield, is because dividend names are the type that you want to sell calls in. So now let's talk about you as a money manager, a registered investment advisor, a hedge fund manager, or you're a individual private investor with some dough. And you're asking yourself, well, should maybe I just, you're a money manager, you're scared of robo-advisors, right? Or just the automated investing. And you're looking for a way to differentiate, right? Or an RIA, does telling your clients, hey, I've got this great mutual fund for you, differentiate you? No. If you're an individual investor, does putting money in mutual funds or robo investing differentiate you? Does that help you really get ahead? No. No, it does not. So the next piece that you have to think about is, how do you differentiate? How do you beat them? And the answer is double the dividend. Covered call strategies. So despite the simplicity, covered calls are maybe executed and traded by less than 5% of RIAs, financial advisors, and money managers. It is such a great way of differentiating yourself. It changes the way that your income stream will look. And if you're a money manager or an RIA or a portfolio manager or an individual investor and you want to be better, covered calls. All right, so now, leading managers all over the country are starting to use options to produce income. And this is just the tip of the iceberg, guys. And what I want to do is teach you to build marketable programs that you can use with your clients, or a program you can use for your own wealth. All right, so I can show you. And what does that mean? Well, we have all these great strategies that you needed to learn to differentiate. Put selling strategies, wheel trading strategies, hedging strategies, stock replacement strategies, and this is a big one, strategies for customers with concentrated wealth. The high net worth individuals are begging for this. So what is concentrated wealth? Well, concentrated wealth is someone who worked for IBM for 20 years or 30 years or 40 years and was counting on all that wealth still being there. Or General Electric, right? Take a look at the path of GE. How's that been? Well, when you have all of your wealth concentrated in one stock, you put yourself at risk. And one of the things that robo-advisors really aren't great at, and I think adds nuance to money managers, is helping with concentrated wealth. So now, options for investors, money managers, and RIAs. This is a money masterclass for all of you. What we're going to do. On your screen too. Oh. What this is going to do is we're going to help you start by using options to manage money and hedging. Now, we're going to start as if you don't know a lot. All right? So if you're a little scared, don't worry. We're going to get there. But this course is going to crescendo to helping you build a system trade. I've written 2 books, The Option Trader's Hedge Fund with Dennis Chen and myself, and Trading Options for Edge. And both the themes of those books are creating businesses. So we're going to teach you how to use options for hedging. We're going to help you learn to create income for an options for a portfolio. Triple, quadruple the dividend. We're going to teach you to master covered calls and cash secured puts and wheels. And I think this is important. We're going to work with you on building a system trade. And so what essentially amounts to option SMAs that will really differentiate you as a money manager. And the beauty is this course, if you're a chartered financial planner, certified financial planner, this course comes with 12 hours of CE credit. You have to take it you have to buy it by the end of the year, but it's 12 hours of continuing ed credit. And we all know you need it. So if you go to our store and you want to buy this, right here, $1,497. Sign me up. That's a deal. However, this 10-hour course that gives you 12 hours of CE credit, I'm going to let you have for $497. And if you buy it today, when you get through the course, we will do a 1/2 hour consultation with you to help you implement the option strategy that you're interested in implementing. You go to optionpick.com/CE12 and you sign up for $497. This page will also be where you can find a replay of this webinar. Who has questions? All right, the question one, what if we want to keep the stock to make an extra income apart from regular dividends? There are risk mitigation ways that we can teach you so if the stock continues to run up, you are able to participate in upside. Someone makes the comment that you can triple the dividend with a call condor. Well, yes, but that is a lot more complex and there's a lot more to it. That also invites a lot more risk. What I would say is that the amount of understanding that approach takes relative to the income it produces, there are better strategies. And then I will take one more question and we'll call it a day.